Wayne Wilbanks is Chief Investment Officer at Wilbanks Smith and Thomas Asset Management, and he manages $1.2 billion with a B dollars. He says investors should hold current positions and focus on areas like fixed income and U.S. blue chips. Wayne joins us live from Virginia Beach. Great to see you, Wayne. I don't know, you want to aim for managing $1 trillion? Why not, right?
That would be great.
All right, so you talk about three factors pushing the market higher these days.
Yeah, I think as you look at what's going on in the market, this is going to be a very jobless recovery. But what's pushing the S&P 500 higher is you've got really easy comparisons for the S&P 500 companies from people like Texas Instruments. I mean, these companies are really blowing their numbers out right now. Second, the banks are all paying back TARP, all these funds you've seen in the last 2 days with Wells Fargo, Citigroup, and that is underlying the entire financial system. A lot better health going on there. And third, the one that doesn't get any press is the emerging markets. These global economies, Brazil, Russia, India, China, are exploding on the upside, and they're dragging the entire rest of the globe along with it. And that's what you're hearing out of all these U.S. companies that do business overseas. Literally, they can't fill some of the orders for some of these exporting economies. So we should be thankful that these emerging economies are growing the way they are right now.
And you're very cautious. Challenges do lie ahead. Again, you're cautious on prospects for the new year. Explain why.
Well, it all centers on one word, and that's debt. I mean, you see debt on the state level, the federal level. The consumer is saving to pay down his debt. And deleveraging is very, very painful. And what it's going to do is take probably 1 to 2% out of GDP growth for the next 2 to 3 years. And so I don't think we've really all kind of taken that fully into consideration as we go forward. So we'll see this, the third and fourth quarter look okay, but as you get into 2010, second half, the stimulus runs out, people are still saving, state budgets are a mess, layoffs continue. So we don't see unemployment dropping back down to 8% probably for 2 years, and that's going to be a huge drag on the economy and the market.
But Wayne, you were expressing some caution about 2010. So how are you advising your clients to position themselves?
Well, we think it's a great time for investors, now that we've had this huge move up off the bottom for the market, to stress test their portfolios and ask themselves, how would I feel if we have a 20% drop in the S&P 500? How's that going to impact my portfolio? And am I fine with that? And if not, it's a great time to lower your equity allocation, mainly because we think there's probably another 10% to go on the upside, but there's 10 to 15% on the downside. So that risk-reward trade-off begins to look not so enticing relative to being able to get some yields on fixed income right now.
All right, so if you're lowering your equity exposure, do you pump up the fixed income or cash side?
Well, we're doing the fixed income and also looking at other asset classes, whether it's commodities or whether it's alternative energy. I mean, there's a number of different areas outside of regular equities that you can look at. But corporate bonds still look attractive. And flip side of that, U.S. Treasury bonds look very unattractive. We think rates are going higher. And as they go higher, that's going to be bad for bond investors in the highest quality instruments.
Not even on the front end of the curves, 2s, 5s? Nothing there for you that strikes your interest?
Yeah, investors need to realize how quickly you can lose money. If you buy a 5-year Treasury paying 2.8% and rates go to 3.5%, you're done for the year. You've literally erased 5 to 10% of your capital.
All right, so as for equities, what industries do you think will provide the best value here in the new year?
Well, our big focus on the broad scale would be U.S. blue chip equities look very attractive, and some of the areas in particular, technology, the big names like Microsoft and these Texas Instruments, these companies are really benefiting from a tailwind of what we think will be better capital spending. And then, believe it or not, some of these large banks, such as Bank of America, are really in a position to make a lot of money over the next 2 years. They borrow for almost nothing. They've paid back their TARP, and they're dictating the terms with their clients right now, which is very good for their bottom line.
Are you concerned, though, about these ongoing lending issues, especially those might be problems more for the small and community level banks, no?
You hit it right on the head. I mean, it's a day of haves and have-nots. The have-nots, unfortunately, are a lot of these small community banks. You're going to see where we've lost 140 banks so far, maybe. We're going to lose 400 or 500 before we're over. And those are the ones that have leverage. They're lending to the wrong people. But these strong local banks and then these big top 25 that have paid back TARP are in a really good position to make a lot of money.
And you've got that steep Treasury yield curve, which has got to be helping them. as well.
Exactly. We think, yeah, exactly. We think the damage on the interest rate front will be in really the 7 to 30-year range. The Fed can control 1-year and 3-month rates. They can keep those down forever. But what they can't control is the 10-year going from 3.7 to 4.5%, which is where it should be right now. It's artificially being depressed by the government. So when rates go back to 4.5, that's not good for Treasury investors.
Back to technology, one of the industries you said you liked. You know, I'm concerned with unemployment so high. We were talking earlier today. We've heard a lot of analysts expressing concerns. You know, retail sales for the holiday season have been disappointing. So is spending and a lack thereof really going to be a problem for this industry, or will the products be so new and so innovative that everyone's going to, you know, have to have, for example, a smartphone?
Well, we look at it more on the corporate side. This will be a corporate-driven capital spending cycle. I look at our company. We're getting ready to switch to the new Windows products, and we're upgrading systems. And things you might have put off last year as a CFO or a CEO of a company. The companies are doing well right now. Remember that. Corporate profits are coming back. They're not hiring anybody. So they've got extra money sitting on their balance sheets to buy new computer equipment. So we think it's it's good for Microsoft, because you're going to see a lot of companies that put it off for the last 2 years. So on the individual side, they'll still buy the $199 iPhones, but we're much more focused on the tech capital spending cycle right now.
Wayne Wilbanks, thanks so much for the chat. Have a wonderful holiday. Wayne
Same
Wilbanks.